Hi everyone. Mm, good evening. Let's talk today about intrinsic value. So, what is intrinsic value? So, typically, there's a saying price is what you pay, whereas value is what you get. So, the most important metric that's been used by Warren Buffett is intrinsic value. So, this is something that he always stresses upon as the most important metric that one has to consider. So, for example, you purchase something for a particular price. So the price is what you pay, whereas the amount of value that you get from it is far higher than what you are paying. So that is how you should purchase your stocks. So this is the definition. So it is a discounted value of the cash that can be taken out of a business during its remaining life. So basically, it is an estimate and not an exact number. So it will be a probability. So you can say a stock is worth between 800 to 1000 rupees because based on a single percentage point, a single change in interest rate move or cash flow, it can actually change dramatically. So let's look at how this works in the stock market parlance. So you can see the earnings here. The earnings of a company keeps going up. So this is the intrinsic value of these and the stock price. So the as the company keeps growing, as the company keeps growing its sales numbers as well as profit numbers, what happens is it has a far better book value. It has a far better EPS. So if you look at this graph, the share price will eventually follow the earnings. So if a company keeps growing, so there will be minor dips here and there, but eventually it will be trading at uh, on par with that value or above that over a period of time. So that is where you should always look to purchase a company at a price that is below its intrinsic value. So price is what you pay, whereas value is what you get. For example, you own a shop. So let's say you own a small shop, which makes around 1 lakh rupees per year profit. Okay. So if you think that this income will continue to remain stable over the next 10 years, then you can calculate its intrinsic value by assessing its long-term potential rather than just today's sales price. So over a period of time, how much revenue it can generate, how much cash flow it can generate. So based on that, you can come up with an intrinsic value. So similar to that, you can come up with an intrinsic value for a specific share and then purchase a company based on its valuation, based on its earnings and future potential. Yeah, thank you.